short, some say. Life is long, others say. Regardless, you need to plan. After all, you shall retire one day, which is when your regular income will dry up. But not your expenses. And you've got to plan for that. There are many ways you can prepare for retirement. One of them is the pension plan. A pension plan is a plan where you first build up or accumulate a certain sum of money, a corpus of funds, by making regular payments called premiums during your employment years, so that by retirement, that very corpus of funds starts making payments back to you on a regular basis in order to meet your living expenses. In other words, you build up that corpus slowly and steadily before retirement, which then becomes the provider of your living expenses after retirement. Not a bad thing, because you build up your own corpus that provides you with a pension upon maturity. Now, technically, it is called annuity. It means receiving a regular payment from your own corpus of funds. Every person must look at this, but especially those of you who live and work in the Middle East, because at some point in time, you may want to come back and settle in India. Who knows? So, let's look at the different types of pension plans. There are several types of pension plans that you can buy in India. 1. Immediate versus deferred plan. 2. Fixed term versus lifelong payment plan. 3. With or without life cover plan. 4. Participating versus non-participating plan. Within all these, they may differ on withdrawal limits upon maturity. They may differ on tax exemptions, and so on. First, let's talk about the immediate plan versus the deferred plan. The immediate plan is the one where you make a lump sum payment to purchase the policy from the pension plan provider, and your pension begins nearly immediately. And that's why it's called immediate plan. However, not everyone has or wants to block a large amount of money to purchase the policy all at once. You may want to make small payments regularly over a period of time, typically covering your employment years. These payments, also called premiums, can be made on monthly, quarterly, or yearly basis to accumulate these payments into one big corpus by the time you retire. Starting then, the pension plan provider will begin making pension payments to you regularly. Because you built up the corpus on a deferred basis, this is called the deferred plan versus the immediate plan that we spoke about before this. Now, the question is, how long will the pension plan provider keep paying you the regular pension? You can choose a plan where you receive payments lifelong, and that's called annuity life, or over a fixed number of years, which is called annuity certain. And in both cases, annuity life or annuity certain, you can select options so that your spouse can receive the pension in the unfortunate event of, let's say, after you. The third important factor is the life insurance cover. You can choose a plan with life insurance cover or one without life insurance. If with life insurance, your nominee will be entitled to the fund value as a lump sum amount after you, even if this happens before the maturity of your policy. Without life cover, the nominee will get back the fund value to the extent of your paid up corpus. On top, you can enhance the life cover with elements such as critical illness or disability due to accident and so on. Should you face critical illnesses, you may need the money to access medical care. Some plans do return the premium amount to you for such treatments. That was the third factor. The fourth one is participating versus a non-participating plan. With a participating plan, you participate in the profits of the company. You get bonus or dividends as the case may be. They call this a policy with profits. On the other hand, the non-participating plans got nothing to do with the company's performance. No bonus, no dividends. Immediate annuity is, for example, a non-participating plan. Overall, you can choose the single or joint life options. Joint life option lets your spouse receive payments even after your demise. Let's come to what happens upon maturity. Most plans let you withdraw a certain portion, if you wish, typically up to 1/3 of the corpus that you built. The sum that you leave back after withdrawing a portion is the one that pays for your annuity. But if you withdraw a certain portion, please recognize that this is a tax event. Some plans come with built-in tax exemptions such as no tax on withdrawal of up to say 1/3 of the corpus on maturity. Only that portion you withdraw above 1/3 will be taxed. Some plans such as the National Pension Scheme lets you withdraw up to even 60% upon maturity, but does not offer tax exemption. There are many choices based on your age and financial goals. 3 things you must bear in mind. First, expenses go up with inflation, not down. The pension plan should cover you sufficiently. Second, think of life expectancy. The plan must cover you for as long as possible. You shouldn't run out of money ever. Third, there can be healthcare surprises, sudden medical expenses, and so on. So, as you see, a lot depends on what you signed up for. Therefore, please make sure you've asked these questions before you purchase the policy. So, who offers pension plan policies? Well, several private and public sector banks, even insurance companies, do so. Many offer policies especially for NRIs. You can look up State Bank of India, LIC, Bajaj Allianz, and a few others. Hope this was helpful. If you have any questions, send us an email. Or if you want any topic covered, please let us know. Our address is questions@nrinotebook.com. Again, that is questions@nrinotebook.com. See you soon.